First, welcome to the video. Today we'll explore why many investors consider the health savings account the most powerful tax advantage tool in the U.S. We'll explain the triple tax advantage, outline two competing investment approaches, and show you how to implement an aggressive strategy while staying liquid for emergencies. We'll also cover advanced tactics like saving receipts to reimburse tax-free in the future, and finish with key risks and caveats. Now, let's set expectations and walk through today's agenda. Next, here's the agenda. We begin by reframing the health savings account as a long-term investment engine rather than a mere medical checking account. Then we break down the triple tax advantage. After that, we compare two investment philosophies: full-on retirement mimicry versus a hybrid approach that incorporates a cash buffer equal to the plan's out-of-pocket maximum. We will go step by step through implementation, talk about the Shoebox strategy for saving receipts, cover risks and caveats, and test your understanding with a short quiz. Now, before we go deeper, here's an important disclaimer. Now, a quick disclaimer. This video is for educational purposes only and should not be interpreted as financial, tax, or legal advice. Health savings accounts involve rules that can change, and your personal situation, including your health coverage and state tax treatment, may differ. Always consult a qualified professional before making decisions. With that in place, let's clarify what an HSA actually is and why it's so powerful. Next, let's reframe the HSA. Many people use it like a basic medical checking account, paying bills as they go. However, for those eligible under a high-deductible health plan, the HSA can function as a powerful investment account with unique tax features. The key is understanding the triple tax advantage and aligning your investment approach with your timeline and risk tolerance. Let's unpack the triple tax advantage now. Now, let's break down the triple tax advantage. First, HSA contributions reduce your taxable income. They are either pre-tax via payroll or tax-deductible if you contribute directly. Second, earnings inside the HSA compound without current taxes, meaning dividends, interest, and capital gains, grow tax-deferred and, if used correctly, effectively tax-free. Third, withdrawals for qualified medical expenses are tax-free. These three together make the HSA uniquely efficient compared to other accounts. As we transition, we'll examine two strategies to harness this advantage: pure retirement mimicry and a hybrid approach that preserves liquidity. Moving on, this flowchart outlines the decision sequence. You start by confirming eligibility through a high-deductible health plan. Then open an HSA provider that allows investing. Next, decide on your liquidity needs. If you want a safety net, keep a cash buffer equal to your plan's out-of-pocket maximum in a highly stable option such as a money market fund. If liquidity is less of a concern, consider investing the majority or all of your HSA in diversified, low-cost index funds or a target date fund. If you can afford to pay current medical bills from regular cash flow, save receipts and leave HSA assets invested for growth. If not, you can still use the HSA to pay expenses directly. Finally, review and rebalance periodically to maintain your chosen strategy. Now, let's compare the two primary approaches side by side. Now, here's the comparison. The retirement mimicry approach treats the HSA like a traditional retirement account by investing most or all assets in broad market index funds, accepting short-term volatility in exchange for long-term compounding. It is simple and often automated. The hybrid approach preserves an amount equal to your plan's out-of-pocket maximum in a stable option such as a money market fund, ensuring you can cover a major medical event without selling investments at a loss. Dollars above the buffer are invested aggressively, commonly through a target date fund for convenience. Both aim for growth, but the hybrid approach explicitly addresses liquidity needs. Next, we'll define the out-of-pocket maximum and show how to size that buffer. Next, let's focus on the cash buffer. The out-of-pocket maximum is the most you'd pay in a year for covered in-network care before your insurance pays 100%. In the hybrid strategy, you hold that amount in a very stable option, such as a money market fund or cash equivalent inside your HSA. Any HSA dollars above that buffer can be invested in diversified equity funds or a target date fund for long-term growth. If you ever draw from the buffer for a medical event, replenish it before adding to risk assets. Now that we understand the buffer, let's quantify the potential impact of investing versus leaving funds uninvested. Now consider a simple hypothetical. A single $10,000 deposit left for either 10 or 20 years. At a 2% annual yield, the value grows to about $12, $180 after 10 years, and $14,859 after 20 years. At a 7% annualized return, the same $10,000 becomes roughly $19,671 in 10 years, and $38,697 in 20 years. This example ignores fees, additional contributions, and taxes outside the HSA context, and actual returns will vary. The purpose is to illustrate the compounding gap when funds remain uninvested versus invested. With this in mind, let's move into a practical step-by-step setup. Next, here's a concrete implementation plan. First, confirm you are enrolled in a high-deductible health plan and check current HSA contribution limits. Second, select an HSA provider that allows investing, ideally with a money market option, and low-cost index funds or target date funds. Third, automate contributions. Fourth, choose your strategy: pure retirement mimicry, or the hybrid approach that holds the out-of-pocket maximum in cash. Fifth, pick your funds, emphasizing broad diversification and low fees, or consider a target date fund for simplicity. Sixth, set auto-invest instructions so amounts above your buffer are invested. Seventh, save and digitally store all qualified medical receipts with dates and amounts. Eighth, rebalance annually and review fees. Ninth, if you can cover medical costs from regular cash flow, delay HSA reimbursements to keep assets invested for longer growth. Now, let's visualize a sample allocation. Now this pie chart shows an illustrative allocation. 30% represents the cash buffer equal to the plan's out-of-pocket maximum, though the actual percentage depends on the size of your HSA relative to that maximum. 60% is allocated to broad equity index funds for growth. 10% is in bonds or international diversification. As your account grows relative to the OOPM, the buffer will typically represent a smaller percentage, allowing more capital to remain invested for growth. Next, let's talk about advanced tactics, such as the Shoebox strategy for receipts. Next, consider the Shoebox strategy. If your budget allows, pay for current qualified medical expenses with non-HSA funds and save the itemized receipts and explanation of benefits documents in a secure digital archive. You can reimburse yourself from the HSA years later, tax-free, as long as the expenses were incurred after the HSA was established and you retained proper documentation. The advantages include keeping your HSA invested longer for compounding and having flexibility to time reimbursement strategically, for example during a year with higher expenses or lower income. Now, to visualize the timing, here's a timeline of how this can work. Now this timeline demonstrates the Shoebox approach. In year 1, you open your HSA and incur an $800 qualified medical expense, which you pay out of pocket while saving the receipt. From years 2 through 10, you continue investing and compounding your HSA while still saving receipts for any qualified expenses paid out of pocket. In year 11, you decide to reimburse yourself the original $800 tax-free using the saved documentation. The key is that the expense must occur after the HSA is established, and you must maintain proof. Next, let's test your understanding with a quick quiz. Now, a quick quiz. The question is, which combination best describes the HSA's triple tax advantage? Option A, tax-deductible contributions and tax-free withdrawals only. Option B, tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. Option C, tax-free growth only. Option D, taxable contributions, but tax-free withdrawals. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Next, here's the answer. The correct choice is HSAs combine tax-deductible or pre-tax contributions, tax-free growth inside the account, and tax-free withdrawals when used for qualified medical expenses. This unique combination is why HSAs are often called triple tax advantaged. Now let's try one more question about the cash buffer. Now the next quiz question is, in the hybrid HSA approach, what is a prudent target for your cash buffer? Option A, $1,000 flats. Option B, 3 months of living expenses. Option C, your health plan's out-of-pocket maximum. Option D, no buffer. Go 100% stocks always. You may pause the video now to consider. We will talk through the answer in the next section. Now the correct answer is C. Targeting your plan's out-of-pocket maximum for the cash buffer helps ensure you can handle a catastrophic medical bill without selling investments during a downturn. This balances liquidity and growth. Next, let's cover key risks and caveats before we wrap up. Next, we must address risks and caveats. Aggressive investment allocations can be volatile, so account values may drop sharply at times. The documentation burden is real. If you lose receipts, or they do not meet requirements, you cannot reimburse tax-free. Only qualified medical expenses are eligible. Verify the IRS rules for what qualifies. Contributions typically cease once you enroll in Medicare, and regulations can change over time. Some states may not offer the same tax treatment as federal law, potentially taxing HSA earnings. Finally, fees and fund menus vary widely across HSA providers, so compare costs and options. With those cautions in mind, let's consolidate the key takeaways. Next, here are the key takeaways. When used correctly, HSAs can deliver unmatched tax advantages. The most common mistake is allowing sizable HSA balances to sit uninvested. You can choose a straightforward retirement mimicry approach or opt for a hybrid that preserves your out-of-pocket maximum in cash while investing the rest. If you can afford to pay medical expenses out of pocket today, saving receipts for later reimbursement can enhance compounding. Be sure to monitor fees, understand the rules including any state-level differences, and maintain careful documentation. Finally, let's summarize and close out. Finally, here's the summary. Treat your HSA as a long-term growth engine rather than a short-term cash drawer. Choose a strategy that fits your liquidity needs. Either invest like a retirement account or hold a cash buffer equal to your out-of-pocket maximum and invest the remainder. Consider the Shoebox method to delay reimbursements and keep assets compounding. Document everything and revisit your setup annually. To conclude, we appreciate your time and have one last request. As a final note, thank you for watching. If you found this helpful, please like the video, share it with someone who could benefit, and subscribe for more practical, research-backed money content. We would love to hear about your own HSA strategy and lessons learned. Share your thoughts in the comments. See you in the next one.